Every now and then in crypto, you stumble upon something that feels like it's about to rewrite the entire playbook. Right now, that's exactly what's happening with HBAR and its surrounding ecosystem. What we're seeing isn't just the usual pump and dump hype cycle or some influencer-driven frenzy. No, this feels much deeper. It feels like a genuine shift in the way both investors and users are starting to view Hedera as a serious infrastructure layer for the future of decentralized finance, tokenization, and Web3. And here's the part that most people are missing. It's not just about HBAR anymore. HBAR is the heartbeat, sure, but if you really want to understand where this thing is going, you need to look at the whole ecosystem. That means looking at the projects building on Hedera, projects like Gib, Bonzo, SaucerSwap, and others that are forming this tightly connected network of liquidity, staking opportunities, and real use cases. Because the ecosystem isn't just one chain with a coin. It's an evolving economy, and every economy needs layers of infrastructure. You need your base currency, you need exchanges, you need liquidity providers, you need staking, and you need those little micro-projects that attract the community and keep things sticky. Hetera is starting to show all of that in action. Now, I know people have been burned in crypto before. You probably have too. We've all seen coins promise the world and then vanish into thin air. That's why I don't want you to think of this like just another to-the-moon prediction. What I'm asking you to do is zoom out and look at the structural signs of growth. Because if you've been in crypto long enough, you know the difference between hype and momentum. Hype dies fast. Momentum builds slowly, gets stronger, and eventually becomes almost unstoppable. What Hedera has right now is momentum. Let's start with HBAR itself. Over the past few months, the performance of HBAR has been nothing short of impressive. Not in the sense that it skyrocketed 100x overnight, but in the sense that it has held strong in conditions where other coins have been bleeding. That's always a big clue. Think back to previous cycles. Remember how in 2017, Ethereum held up while dozens of other projects were crashing? Remember how in 2020 Bitcoin started moving before everything else followed? That's often how you can tell when a chain has genuine staying power. Hedera is starting to show that kind of behavior. But what really gets me excited is how the ecosystem projects are starting to ride that wave. Take Gib, for example. This isn't just some random token with no utility. Gib has been gaining traction because it's tied into the actual liquidity dynamics of the Hetera network. Same with Bonzo. Same with SaucerSwap, which is becoming the go-to DEX for Hedera users. You're starting to see the puzzle pieces fit together. HBAR as the backbone, these ecosystem coins as the capillaries that spread liquidity and keep users engaged. That's how ecosystems grow. Think about Ethereum again for a second. Back in 2017, ETH was cool, but what made Ethereum explode wasn't ETH itself. It was DeFi, it was MakerDAO, it was Uniswap, it was the endless list of ERC20s that built the sticky economy. You didn't just buy ETH, you bought into the ecosystem. That's exactly what's starting to happen here. People aren't just stacking HBAR. They're engaging with Hedera through all these satellite projects. And once that kind of engagement starts, it becomes very hard to slow down. Now, let's talk about staking and liquidity because this is one of the most underrated shifts happening in the Hedera world. When you introduce real staking opportunities with solid yields, not the insane, unsustainable 10,000% APYs you saw in the early DeFi days, but consistent, reliable returns, you create a reason for people to lock up tokens. And when tokens are locked, supply gets tighter. And when supply gets tighter, price pressure starts to build. It's simple economics, but it's incredibly powerful when combined with growing demand. Liquidity works the same way. SaucerSwap is a perfect example. As more people start providing liquidity, the trading experience on Hedera becomes smoother, spreads tighten, slippage goes down, and suddenly you've got a DEX that can actually compete with the big boys on Ethereum or BNB chain. That attracts traders. Traders bring volume. Volume brings fees. Fees attract more liquidity providers. It's a flywheel, and Hedera is finally starting to spin that flywheel. But here's the kicker. All of this is happening at a time when the broader market is just starting to wake up. We're not in full bull mode yet. We're in that accumulation phase, the one where the smart money starts quietly positioning itself before retail catches on. You can see it in the charts, you can see it in the way wallets are accumulating, and you can see it in the slow but steady rise of ecosystem tokens. This is the stage where conviction pays off later. Let me paint you a scenario. Imagine it's 2020 again. Bitcoin is sitting under $10,000, ETH is under $300, and everyone's bored. Nobody wants to touch crypto because the headlines are all doom and gloom. But the people who were quietly buying then, they're the ones who looked like geniuses a year later. That's the kind of window we're in right now with Hedera. You don't always realize it in the moment, but in hindsight, it becomes painfully obvious. And I get it. People are skeptical. They'll say, but Hedera isn't as hyped as Solana. Or, it doesn't have the same meme culture as Doge or Shiba. And you know what? They're right. It doesn't. But that's exactly why it has room to run. Hype burns fast. Fundamentals last. Hedera is quietly building those fundamentals while everyone else is distracted by whatever the latest meme coin of the week is. And once the spotlight shifts, which it always does, the projects with real staying power are the ones that benefit the most. Now, let's touch on psychology because this is where most investors get wrecked. The market runs on psychology. People buy when they feel good, and they sell when they're scared. That's why breakouts are so powerful. When HBAR broke through key resistance recently, it wasn't just about the technical chart, it was about psychology. Traders saw that breakout and thought, okay, this thing is serious now. That's how momentum builds. And when you've got momentum in the base token and excitement in the ecosystem tokens at the same time, that's when you get explosive moves. It's not just one coin pumping. It's a network effect. It's HBAR lifting GIB, lifting Bonzo, lifting SaucerSwap, and in return those tokens bring more users back to HBAR. It's circular. It's reinforcing. And that's exactly what makes an ecosystem sustainable. So here's what I want you to take away from this first chunk. Don't think of Hedera as just HBAR. Think of it as an economy. Think of it as Ethereum in 2017 or Solana in 2020. The base coin is strong, the ecosystem projects are starting to get traction, staking and liquidity are creating tighter supply dynamics, and the psychology of the market is starting to shift in its favor. These aren't random signals, they're the building blocks of a long-term trend. If you're paying attention now, you're ahead of the curve. And being ahead of the curve is where the real opportunities always lie. Alright, now that we've laid the foundation with HBAR itself and the ecosystem's momentum, let's zoom in on the projects that are quietly shaping Hedera's future. Because make no mistake, this next phase of crypto isn't going to be won by a single coin. It's going to be won by ecosystems that can prove they're more than just hype. And Hedera is stacking its deck with some seriously interesting players. Let's start with SaucerSwap. If HBAR is the heartbeat, SaucerSwap is the circulatory system. Every chain needs a DEX, it's non-negotiable. Without a strong decentralized exchange, liquidity gets trapped, adoption slows down, and users drift to other chains. That's exactly why Ethereum exploded after Uniswap, and why Solana's rise was powered by Serum and Radium. Hedera needed its Uniswap moment, and that's what SaucerSwap is shaping up to be. What's impressive about SaucerSwap isn't just that it exists, but that it's starting to build volume and stickiness. We're seeing real liquidity pools form, actual trading pairs that matter, and yields that incentivize people to park their tokens and stay engaged. That's the lifeblood of an ecosystem. You can have the best base layer tech in the world, but if people can't swap tokens easily, the chain dies. SaucerSwap solves that for Hedera, and it's still early. Next up, GIB. Now, GIB isn't trying to be the next ETH killer or Bitcoin replacement. What it's doing is arguably smarter. It's embedding itself into Hedera's growing liquidity network as a community-driven project that people can actually rally around. And if you've been in crypto long enough, you know community projects often carry ecosystems on their back in the early days. Remember Doge on Bitcoin? Remember SHIB on Ethereum? Meme coins sound silly until you realize they bring millions of eyeballs, create network effects, and give people an entry point that feels fun. GIB is doing exactly that for Hetera, except it's tying itself into the serious liquidity infrastructure too. Then there's Bonzo. Bonzo is where things start to get interesting because it isn't just about speculation, it's about adding practical utility. Whether it's staking opportunities, liquidity partnerships, or simply expanding the Hedera economy, Bonzo is the type of mid-layer project that turns an ecosystem from tech demo into economy. The way it's positioning itself reminds me a lot of early Polygon projects. Not flashy enough to make mainstream headlines, but critical enough to attract sticky capital. And here's the magic. When you zoom out, you see these projects aren't isolated. They're connected. SaucerSwap provides the liquidity rails. GIB brings in the community energy and trading volume. Bonzo adds layers of utility and staking incentives. Together, they form a cycle of growth that strengthens HBAR at the core. And that's when you know an ecosystem is maturing. But let's not just talk theory, let's anchor this in some context. Look at what happened in Europe during the last cycle. European institutions were some of the earliest to test Ethereum's tokenization frameworks. Projects in Germany, Switzerland, and the UK started experimenting with securities tokens, stablecoins, and regulated DeFi pilots. Why? Because they saw the writing on the wall. Blockchain isn't just about trading. It's about infrastructure. Fast forward to now, and those same institutions are looking at Hedera as a more efficient enterprise-grade alternative. SaucerSwap could easily become a gateway for European fintech players who want DX exposure without Ethereum's gas nightmares. Over in the United States, the narrative is even clearer. The SEC is slowly, painfully moving toward clarity. And in the meantime, American startups are hunting for chains that can handle compliance, speed, and cost-effectiveness. Hetera, with its governing council of heavyweights like Google, IBM, and Boeing, has the credibility that most chains can only dream of. When a U.S. startup wants to tokenize assets or build a regulated DeFi product, are they going to choose some anonymous chain run by a few VCs? Or are they going to choose Hetera with Fortune 500 sitting at the governance table? Exactly. And this is where I want you to think long-term. These ecosystem tokens, GIB, Bonzo, SaucerSwap, they may look small now, but so did Uniswap's Uni in 2020. So did Matic when it was trading under a cent. The lesson from past cycles is simple. Base tokens give you stability, ecosystem tokens give you leverage. The smart money doesn't pick one or the other, they hold both. Let's also touch on staking because this is a massive catalyst hiding in plain sight. Staking is what turns passive holders into long-term believers. If I can park my HBAR or my Bonzo tokens and earn a steady return, suddenly I'm not just speculating. I'm investing. And the longer I invest, the less likely I am to sell during dips. That creates supply squeezes. And supply squeezes create price shocks. When you layer this dynamic across multiple ecosystem tokens, you start to see how powerful the network effect can become. Now, people might ask, but what about competition? Isn't Solana doing the same thing? Isn't Ethereum still king? Sure, competition is real. But here's the thing, crypto isn't a zero-sum game. Just like the internet didn't end with one website, Web3 won't end with one chain. Different chains will serve different niches. Ethereum is the global settlement layer. Solana is gunning for speed and retail apps. Hetera is carving out a space for enterprise adoption and eco-friendly scalability. And as that niche grows, the ecosystem tokens tied to Hetera are going to grow with it. Here's something most people overlook. Hetera isn't just decentralized finance. It's decentralized everything. Supply chain tracking, carbon credits, enterprise tokenization, payments infrastructure. These are trillion-dollar industries, and every time Hetera sinks its claws into one of them, the liquidity will ripple outward to SaucerSwap, GIB, Bonzo, and yes, back to HBR itself. That's the domino effect you want to be positioned for. Think about it like this. Back in 2015, people said Ethereum was just a smart contract platform. In 2020, they said Solana was just another altcoin. Now, Ethereum is worth hundreds of billions. Solana went from $2 to $250, and the skeptics look silly. Hetera is sitting in that same quiet, underestimated position right now. The question is, are you going to see it for what it is? Or are you going to wait until it's obvious when the easy money's already gone? And let's not ignore the psychology of breakouts we touched on earlier. Every time HBAR pushes through resistance, the ecosystem projects get a halo effect. Traders look at GIB and think, if bar's pumping, GIB's next. Same with Bonzo. Same with SaucerSwap. That's how you get chain-wide rallies. And when the narrative shifts, when people start saying Hedera season is here, that's when the FOMO floodgates open. So here's the bottom line for this chunk. Hedera is more than just HBAR. It's an economy in the making. Saucer Swap, GIB, Bonzo, and others are the gears that make that economy turn. They may look small today, but history tells us these are exactly the kinds of projects that become monsters in the next cycle. Europe and the US are already setting the stage for institutional adoption. Staking is locking up supply, and the psychology of momentum is beginning to tilt in Hedera's favor. If you understand that now, you're already ahead of 95% of the market. Now that we've unpacked Hedera's ecosystem projects and their role in building momentum, let's drill down into something most traders underestimate: adoption signals and real-world use cases. Because no matter how flashy the tech is, if no one's using it, it's dead weight. But if adoption is creeping in quietly, that's when you want to be paying attention. The first and loudest adoption signal for Hedera is its governing council. This isn't a random collection of anonymous devs. It's Google, IBM, Boeing, Dell, Standard Bank, Deutsche Telekom, and more. These aren't just names on a website. They're actively building on the network. When Deutsche Telekom stakes HBAR and runs a node, that's not speculation, that's corporate validation. When IBM integrates Hedera into supply chain tracking, that's not theory, that's enterprise-level testing of blockchain infrastructure. Compare that to most chains where adoption is measured in meme coin listings, and you see the difference instantly. Another adoption signal is enterprise tokenization. Hedera is positioning itself to handle the tokenization of assets. Everything from carbon credits to real estate to supply chain certificates. This is where Europe is quietly moving fast. Germany, Switzerland, and the UK have been running pilots on blockchain-based securities and green finance products. Hedera's low-cost, eco-friendly consensus model makes it one of the strongest candidates to host those pilots at scale. Imagine billions in European green bonds being tracked on-chain, and Hedera providing the infrastructure behind it. That's not far-fetched. It's already starting. In the United States, the adoption angle looks slightly different. Here, it's about compliance and credibility. Regulators are tightening the noose, and projects that want to survive long-term need to look regulator-friendly. Hedera has that edge. With a governing council full of Fortune 500 companies and an emphasis on transparency, it doesn't look like a Wild West blockchain. It looks like a serious contender for regulated adoption. That's why US startups experimenting with tokenization, payments, or DeFi infrastructure are increasingly drawn to Hedera. It's the same playbook that got Ethereum into the door with institutions, but Hedera is offering it at a fraction of the cost and carbon footprint. Now let's talk tokenomics, because this is where Hedera really stands out. Unlike inflationary chains where supply keeps ballooning, HBAR has a fixed cap of 50 billion tokens. No more. That scarcity is crucial. Every transaction, every tokenized asset, every staking contract draws demand from that fixed pool. And here's the kicker. The more ecosystem projects like Saucer Swap, GIB, and Bonzo gain traction, the more liquidity gravitates toward HBAR. It's not just the base layer token. It's the reserve currency of the entire Hedera economy. Staking is another overlooked layer of adoption. When you can lock up your HBAR or ecosystem tokens for yield, it changes behavior. Holders stop flipping short-term and start thinking long-term. That reduces circulating supply. Reduced supply, combined with growing demand from adoption, creates price pressure. And that's how you get explosive upside. People love to talk about catalysts like the next bull run, but tokenomics is the slow burn that makes those catalysts actually stick. Let's connect this to psychology. Traders move in crowds. When they see institutions testing Hedera, when they see adoption in Europe and the US, when they see staking yields rising and ecosystem projects growing, it flips a switch. Suddenly, Hedera isn't just another altcoin. It's the next big thing. And once that narrative sets in, the rally feeds itself. We've seen it happen with Ethereum, Solana, Polygon. It's the same movie, different chain. The early adopters reap the biggest rewards. So here's the takeaway for this chunk. Adoption is already happening, quietly but steadily. Europe is using Hedera for tokenization pilots. US startups are leaning on it for compliance-ready infrastructure. Its tokenomics are designed for scarcity, not inflation. And staking is reducing supply while locking in long-term holders. When you connect those dots, it's clear that Hedera isn't just a promising project. It's a growing financial backbone. The market hasn't fully woken up yet. But when it does, the window for easy entry will slam shut. If adoption is the spark, regulation is the fuel. And right now, Europe and the United States are shaping the rules of this new digital economy in ways that directly favor projects like Hedera. Let's start with Europe. The markets in crypto assets, MiCA regulation is a game changer. For the first time, there's a unified framework for how digital assets can be issued, traded, and used across the entire European Union. Think about that, 27 countries with one clear set of rules. No patchwork confusion, no wait-and-see uncertainty. This creates the perfect environment for institutions to step in, because compliance is no longer a guessing game. Where does Hetera fit in? Simple. MiCA is particularly friendly to networks that prioritize transparency, sustainability, and stability. Hetera checks all three boxes. Its governance model is open and auditable. Its energy footprint is among the lowest of any major blockchain. And its fixed token supply means regulators don't have to worry about runaway inflation or unstable economics. In other words, Hetera is already built for the rules that MiCA is enforcing. Now let's pull in some real-world case studies. Take BlackRock, the largest asset manager on the planet. When they dipped into tokenized assets, starting with tokenized money market funds and testing blockchain rails for fixed income products, they didn't just do it for headlines. They did it because tokenization reduces costs, increases liquidity, and gives clients real-time settlement. This is exactly the kind of infrastructure that Hetera was designed to provide. Low-cost, high-speed, eco-friendly settlement layers aren't just nice to have. They're essential for trillion-dollar institutions making their first moves into Web3. Then there's JP Morgan. Their Onyx blockchain division has been leading pilots on tokenized deposits, cross-border payments, and institutional DeFi. They're proving that banks don't just want to experiment, they want to operationalize. And while JP Morgan has leaned heavily into Ethereum-based pilots, regulators' growing scrutiny of gas-heavy, energy-intensive networks means banks will start diversifying. Hetera, with its energy efficiency and regulatory alignment, looks like a prime candidate for second-phase adoption. The story here isn't about whether Hetera will replace Ethereum or Solana. It's about coexistence. Institutions will use multiple chains depending on their needs. Hetera's lane is clear: regulated, sustainable, enterprise-grade settlement. When MiCA sets the stage in Europe, and when U.S. regulators finally provide clarity on tokenization and stablecoins, Hetera is in the perfect position to slot into those compliance-first environments. Let's not ignore psychology here either. Institutions like BlackRock and JP Morgan don't just move markets, they move narratives. The moment BlackRock launches a tokenized bond on-chain, retail traders scramble to find the next chain institutions will use. The moment JP Morgan runs a cross-border settlement on Hetera, or even hints at it, the floodgates open. Traders chase hype, but institutions chase efficiency. And when the two overlap, that's when you get parabolic moves. Now, here's what most people miss. Regulatory clarity doesn't slow innovation, it accelerates it. Retail often fears regulation, thinking it's about control. But for institutions, regulation is permission. MiCA isn't a barrier, it's a green light. The same is true in the U.S. Once the SEC and CFTC define their lanes clearly, the biggest banks and asset managers won't hesitate. They'll deploy billions. And they'll deploy it on networks that can handle scale, cost efficiency, and compliance. That brings us back to Hedera's unique positioning. Unlike other chains that are still scrambling to retrofit governance or environmental metrics, Hedera was designed from the start to be enterprise-ready. Its governing council model, its energy efficiency, its fixed supply, these weren't afterthoughts. They were deliberate design choices aimed at aligning with exactly the kind of regulations we're seeing now. So let's connect the dots. MiCA opens the door for tokenized assets in Europe. BlackRock is actively testing tokenization and will need efficient settlement layers. JP Morgan is operationalizing institutional DeFi and will look for sustainable rails. The U.S. is moving closer to clear rules that unlock trillions in institutional money. Hedera sits at the intersection of all these forces. Ready, waiting, and positioned. And here's the takeaway. Regulation isn't the enemy. For Hedera, it's the catalyst. It legitimizes the network in the eyes of regulators, institutions, and investors. When Europe and America give the green light, Hedera won't just be another blockchain. It will be one of the backbones of the new financial system. So here's where we stand. Hedera isn't just another blockchain project fighting for attention. It's strategically positioned at the crossroads of regulation, institutional adoption, and real-world utility. With frameworks like MiCA in Europe and clearer rules emerging in the U.S., the stage is being set for networks that prioritize sustainability, compliance, and scalability. That's exactly where Hedera shines. We've seen the signals. BlackRock testing tokenization, JP Morgan pushing institutional DeFi, central banks exploring stablecoins. These aren't isolated events. They're breadcrumbs pointing toward a massive shift, one where trillions of dollars in assets move onto blockchains built for efficiency and trust. Hedera isn't waiting to adapt to this future. It's already designed for it. The question isn't whether institutions will tokenize assets or settle trades on-chain. That's inevitable. The real question is, which networks will they trust to carry that weight? Hedera has the governance, the energy profile, and the infrastructure to be a leading contender. Now, if you've been watching from the sidelines, this is the moment to start paying attention. Because by the time headlines announce major institutions going live on Hedera, the smartest money will already be in. If you found this breakdown valuable, make sure you hit the like button, subscribe, and turn on notifications so you never miss an update. Drop a comment below with your thoughts. Do you think Hedera will capture institutional adoption? Or will another chain take the spotlight? I want to hear your perspective. This isn't just about one project. It's about the future of money, finance, and the internet itself. And trust me, you'll want to be part of that conversation.